Welcome to Talking Markets with Franklin Templeton. We're here today with ClearBridge Investments Head of Economic and Market Strategy, Jeff Schulze. ClearBridge is a specialist investment manager of Franklin Templeton, and Jeff is the architect of the Anatomy of a Recession program, a program designed to provide you with thoughtful perspective on the state of the U.S. economy. Jeff, thank you for joining us this afternoon. I hope you had a great holiday week and a terrific new year. Let's start 2025 off with an update on the ClearBridge Recession Risk Dashboard. Last time we spoke, it was an overall green expansionary color, but progress had stalled with no indicator upgrades since August of 2024. Did anything notable happen in December?
After a period of no indicator upgrades, you saw quite a bit of movement in December. The dashboard experienced 4 individual changes last month, all in a positive direction. Retail sales and building permits both improved from yellow to green. The yield curve and ISM new orders both improved from red to yellow. And given the progress other indicators made beneath the surface, it wouldn't be a surprise to us to see further positive signal changes in the dashboard as we move through the first quarter. Specifically, job sentiment, truck shipments, and money supply are on the cusp of an additional upgrade. So the overall signal right now is firmly in green expansionary territory. And when we look at the 12 individual indicators, right now we have 7 green, 4 yellow, and 1 red signal, but we're expecting more upgrades as we move through the first half of 2025.
Jeff, in the past, you've mentioned that the indicators have different weightings in a dashboard. Can you remind us why that is and what was the most important indicator change last month from a weighting perspective?
So when we look at these indicators, the dashboard is dynamically weighted on 3 particular variables. First off, over the last 8 recessions, how many did the variable get right? How many did it get wrong? Secondly, how many false positives did you give us? If you gave us a false positive every time you got it right, you're not an indicator in the dashboard. And then lastly, what's the consistency of that indicator turning red? Does it turn red every 3 months before a recession, or is it all over the place? And based on those 3 criteria, the dashboard has indicators ranked anywhere from 4% of the dashboard up to 12%. And retail sales is 12%. So it's one of our top rated variables. And we're really excited to see this turn green. And when you look at the consumer section of the dashboard, 5 indicators. With this upgrade, 4 out of 5 of those are now green. And it's really reflective of a robust U.S. consumer. And retail sales is a great barometer of how Americans are doing. The U.S. consumer has been a source of strength throughout the current cycle, a key contributor to why the economy has continued to defy consensus expectations for slower growth. And we really think it's a combination of strong individual balance sheets. For example, household net worth is up over $49 trillion since the beginning of 2020. So that's before the pandemic even happened. And a strong labor market with sticky wage gains, which has helped boost spending power for many people. And when you look at inflation-adjusted retail sales, or real retail sales like we do, it's well above the pre-pandemic trend. So we've been waiting for this indicator to turn green, and we're really excited because it is a top-ranked variable in the ClearBridge Recession Risk Dashboard.
Do you have a specific number or probability that you can give us for the odds of a recession this calendar year?
Yeah, at the moment it's 15%. It's been 15% since October of last year. Actually, last year in 2024, it was 25% or lower for a majority of that year. So at 15% right now, this is about as good as it's ever going to get from a probability standpoint. So from our vantage point, the U.S. economy is firing on all cylinders.
That's terrific news for the U.S. economy. It's been outperforming for years at this point. Can the U.S. continue to outperform the rest of the developed world this year?
Yeah, we believe that U.S. economic exceptionalism is going to continue in 2025 because a lot of the key drivers of superior U.S. economic growth remain intact. We just talked about the consumer. The workhorse of this economy continues to be quite strong. You've had really robust productivity gains in the U.S., especially when you look at other areas of the developed world. And as a reminder to the listeners, when you think about economic growth or GDP, it's a function of two things: the increase of labor force and the increase of productivity growth, or how many more widgets can a factory make this year compared to last year with the same inputs. And productivity growth is now back at levels that we saw prior to the global financial crisis. And with all this investment in AI, we think productivity growth is going to be pretty healthy over the next 5 to 10 years. So this is a pretty big differentiator for the US economy. So the consumer productivity gains, AI investment boom that you're seeing in the US, and really supportive fiscal policy or government spending in monetary policy as well. And even though the Fed may not be cutting as much as what we anticipated this year, the Fed has still cut 100 basis points, which is more than what was needed to create that soft landing of 1995 and 1998. So if you put all of these together, this is the components that you have for another year of U.S. economic exceptionalism.
So U.S. economic exceptionalism is likely here for another year. Can we see more upside this year in U.S. equities after the S&P 500 delivered approximately 25% total return in 2024?
Well, history would say yes. And I think a good parallel here is when you think about a gambler, they often believe that after a long streak of a particular outcome, the probability of a different result has increased. For example, if someone were to flip a coin 5 times, and in each of those instances, the coin landed on heads, many would believe that the odds of tails on the 6th flip are greater than even, or 50-50, in order to bring the sample in line with long-term averages. But the coin has no memory, and the law of large numbers doesn't strictly apply to smaller data sets like 5 or 10 flips. It applies when you have 1,000 or 2,000 flips. So the desire to seek balance can create a gambler's fallacy where past results skew perceptions on what's likely to occur in the future. So when you think about this from a stock market perspective, I hope that this is a pretty strong lesson to be learned. So the S&P 500 delivered 25% total returns in 2024, yet 26.3% in 2023. So you had 2 back-to-back years of equity market returns of 20% or greater. So with the gambler's fallacy, many may believe that the market is due for a bad year because the average long-term annual S&P 500 return is lower. When you look at history, a different story actually comes to fruition. So the market typically continues to deliver solid returns in the year that follows back-to-back 20% gains. This has happened 8 times before, going back to 1950. Average return in year 3, which is this year, is 12.3%, with a positive return happening 75% of the time. So yeah, I think that the S&P 500 is going to have positive returns this year, especially with the economic backdrop that we envision.
So if memory serves me correctly, we didn't have a 10% correction in U.S. equities in the last 2 years. Does that mean we should expect one this calendar year?
No. If you look at this bull market, it's taken a lot of people by surprise. The S&P 500 is up 70% from a total return perspective since the lows back in October of 22. But what's even more notable is that we have not had a 10% or worse correction during the last 2+ years. And although this may seem like an outlier, destined for mean reversion and lower equity prices, history shows that this actually may not be the case. So if you go back again to 1950, the S&P 500 has experienced 9 periods that went longer without a 10% or greater correction. 4 of those periods lasted more than twice as long as we currently stand, and 2 of those periods went over 8 years without a 10% plus correction, which happened in the 1970s and the 1990s. So the fact that we haven't had a correction in over 2 years doesn't mean that one's a foregone conclusion this year. But that said, 2024 had a bit of a weaker tone to it. December was the second worst month of the year, and it's a sign that maybe a period of digestion may be needed after seeing some strength over the last couple of years. And there's a number of catalysts that are out there, but from my vantage point, I really think it may be policy sequencing from the new administration. It might be a little bit of a hurdle near term because we're going to get visibility on the tariffs front first, well before we get visibility on the green shoots that we're going to get from deregulation and tax cuts. So put differently, the headwinds are going to come into greater focus than the tailwinds. But this is a progression that's actually different from the first administration, where you saw the benefits from deregulation and tax cuts in 2017 before giving way to 18 months of tariff-induced choppiness in 2018 into 2019. But I think what's different this time is that tariffs are not going to become as much of a surprise to market participants today versus 6 years ago. But also, we're likely going to get some fiscal support for the economy that's going to overpower some of this tariff drag that we may see in the next couple of quarters. So again, you may see some choppiness here for the next quarter or two, but 10% correction is not a foregone conclusion.
So Jeff, you highlighted tariffs. Outside of tariffs, are there any other things that could cause volatility in U.S. equities?
Well, market optimism right now is elevated. You can look at a number of different investor sentiment metrics, but they're all pretty bullish. One that kind of stood out to me was the Conference Board's Consumer Confidence Survey. The number of respondents expecting higher stock prices in the next 12 months is the highest in history, going back to the 1980s. So generally speaking, when you have pretty bullish sentiment, you may have a period of digestion. Another reason for maybe some bumpiness comes from the fact that the S&P 500 has elevated market concentration. Right now, the top 10 largest companies in the index make up 38.7% of the benchmark, which is a record high. And while this has the potential to be problematic at the index level, it does present a pretty good opportunity for active managers who tend to do better when the average stock is outperforming. In fact, when you look at the top 10 weights of the S&P 500 and they've been elevated like today, the equally weighted S&P 500 has, generally speaking, outperformed its cap-weighted counterpart over the next 5 years. So again, this is a reason why we may see some choppiness. And if you look underneath the surface of the market, a lot of stocks may be doing well on a relative basis, but the index may not move materially higher near term from here.
That sounds like a great opportunity for long-term investors, doesn't it?
This is a tremendous opportunity from a historic perspective. Now, at these levels of market concentration, as I mentioned earlier, we're at 38.7%. The equally weighted index has outperformed the cap-weighted index by 10% per year over the following 5 years. So at this level, there's not a lot of observations, but even if you go all the way back to when the top 10 makes up 25% of the index or greater, you've had no negative observations of relative outperformance for the equally weighted index. In every single instance, the equally weighted index has outperformed over the next 5 years. So it's a pretty crazy statistic. And I think, this represents a really good opportunity for the average stock to start to catch up to some of the larger stocks that have been dominating over the last couple of years.
So Jeff, what do you see as a potential catalyst for such a move?
There's a couple catalysts that come to mind, and it doesn't mean that the markets can't get more concentrated in the quarters to come. Right, in December, the Mag 7 outperformed the equally weighted S&P 500 by 10%. But again, history shows that you typically see mean reversion around these levels of concentration. So from a catalyst perspective, historically, it's been a recession that has seen the equally weighted index outperform. But I think with the economy being relatively strong right now, the catalyst is going to be broader earnings delivery for the average stock in the S&P 500 and smaller capitalization stocks after years of superior Magnificent Seven's earnings growth. So when you have better earnings delivery, these stocks should catch up on a relative basis. So, I think that the laggards of the cycle, small caps, mid caps, value, again, the average stock, have some upside in the environment that we're anticipating. So earnings delivery is going to likely be better this year. The second potential catalyst is that the Magnificent Seven stocks derive over half of their revenues from outside of the United States. The S&P 493, 35% of their revenues. Russell 2000, which are small caps, 23%. So at 53%, substantially larger portion of the Magnificent Seven's top line comes from outside the U.S. versus other areas of the U.S. equity markets, which makes them a little bit more susceptible to the risks of retaliation should we start to see trade wars escalate from here. So there's a number of catalysts that are out there, but all of these catalysts are really fundamental in nature on why you could see the average stock or some of these areas that haven't done so well start to catch up.
So Jeff, earlier you emphasized U.S. economic exceptionalism. Do you think that U.S. equity market exceptionalism will continue this year? Hasn't the recent dominance been primarily a function of valuations?
Well, many believe that a period of outperformance for international equities is, quote unquote, due after a lot of years of U.S. leadership. And while I think this will eventually occur, global equity asset allocation decisions have been susceptible to the gambler's fallacy I talked about before for over 15 years now. So if you go back to 2010, 15 years, if you look at the US and more specifically the S&P 500, it's outpaced the MSCI ACWX US or global equities by 295% cumulatively, and US equities have led in 13 out of the last 15 years. But I think an important differential here is that this large performance differential has been primarily a function of superior earnings growth, which the US has out-earned the rest of the world by 143% over the same time frame. So this means that US relative outperformance over the last decade and a half, and in particular in the last couple of years, have been driven in large part by better fundamentals. And it means that a mean reversion won't likely occur until those fundamentals change. And I just don't see those fundamentals changing over the next 12 months. So I do think another year of US market exceptionalism will happen in 2025.
How do you see positive returns for the S&P 500 with valuations being historically high?
Well, valuations are historically high, but if you look at the average stock in the equally weighted S&P 500, forward PEs right now are 16.3 times earnings versus a historic average of 15.4. So the average stock is actually in line with what we've seen over the last 30 years. So there's a lot of opportunity there. But you don't need multiple expansion to have a positive return this year. If we just hit earnings expectations for 2025 and 2026's earnings expectations remain intact, the S&P 500 is probably going to deliver mid to high single-digit returns before you take into the account the dividend that you're going to get on the index. And the reason why I don't think that you're going to see multiple compression or PEs moving lower, as historically it's been unusual to see meaningful multiple compression in periods where you've had above average earnings growth, which is what we're expecting next year, double-digit earnings growth, and a declining Fed funds rate on a year-over-year basis. When you go back to 1996, when you've had this combination, multiples have expanded by 1.7 turns on average with a positive hit rate of 82%. So while I don't think multiples will necessarily move higher from where we currently stand, strong expected earnings growth and a supportive Fed suggest that multiples remain lofty and that earnings growth is really going to drive forward the positive returns that we're expecting for U.S. equities here in 2025.
We're coming to the close of today's conversation. Thank you so much for sharing your insight and perspective with our audience. Did you have a final thought?
I do. I think the big takeaway from the podcast here is that U.S. exceptionalism from an economic and market standpoint will likely continue here in 2025. The economy is on solid footing with the foundational elements of relative outperformance still intact. The U.S. consumer continues to be a workhorse. You have strong fiscal and monetary supports in place, and productivity gains continue to come through. And with this backdrop, it's really helped set the stage for healthy corporate profits and outsized U.S. market gains. And while it may be tempting to think that the U.S. is due for mean reversion, investors are probably going to have to wait a little bit longer for the fundamental drivers of U.S. exceptionalism to wane in favor of international equities. So in other words, we think that investors should remain cognizant of the gambler's fallacy we talked about earlier, or the notion that the next coin flip will be influenced by the last. And if we do get a period of near-term digestion for equity markets, we think that long-term investors are going to be well suited to take advantage and deploy capital. And we're expecting the laggards, small caps, mid caps, and value stocks, they could become leaders as we look forward to broader earnings delivery here in 2025.
To all of our listeners, a happy and healthy new year. And thank you for spending your valuable time with us for today's update as we kick off 2025. If you'd like to hear more Talking Markets with Franklin Templeton, please visit our archive of previous episodes and subscribe on Apple Podcasts, Google Podcasts, Spotify, or any other major podcast provider.
This material reflects the analysis and opinions of the speakers as of January 7, 2025, and may differ from the opinions of portfolio managers, investment teams, or platforms at Franklin Templeton. It is intended to be of general interest only and should not be construed as individual investment advice or a recommendation or solicitation to buy, sell, or hold any security or to adopt any investment strategy. It does not constitute legal or tax advice. The views expressed are those of the speakers, and the comments, opinions, and analyses are rendered as of the date of this podcast and may change without notice. The information provided in this material is not intended as a complete analysis of every material fact regarding any country, region, market, industry, security, or strategy. Statements of fact are from sources considered reliable, but no representation or warranty is made as to their completeness or accuracy. What are the risks? All investments involve risks, including possible loss of principal. The value of investments can go down as well as up, and investors may not get back the full amount invested. Equity securities are subject to price fluctuation and possible loss of principal. Small and mid-cap stocks involve greater risks and volatility than large-cap stocks. Fixed income securities involve interest rate, credit, inflation, and reinvestment risks, and possible loss of principal. As interest rates rise, the value of fixed income securities falls. International investments are subject to special risks, including currency fluctuations and social, economic, and political uncertainties, which could increase volatility. These risks are magnified in emerging markets. Treasuries, if held to maturity, offer a fixed rate of return and a fixed principal value. Their interest payments and principal are guaranteed. Active management does not ensure gains or protect against market declines. There is no assurance that any estimate, forecast, or projection will be realized. Investors cannot invest directly in an index, and unmanaged index returns do not reflect any fees, expenses, or sales charges. Past performance does not guarantee future results. Any companies and/or case studies referenced herein are used solely for illustrative purposes. Any investment may or may not be currently held by any portfolio advised by Franklin Templeton. The information provided is not a recommendation or individual investment advice for any particular security strategy or investment product, and is not an indication of the trading intent of any Franklin Templeton managed portfolio. Data from third-party sources may have been used in the preparation of this material, and Franklin Templeton, FT, has not independently verified, validated, or audited such data. FT accepts no liability whatsoever for any loss arising from use of this information, and reliance upon the comments, opinions, and analyses in the material is at the sole discretion of the user. Products, services, and information may not be available in all jurisdictions and are offered outside the U.S. by other FT affiliates and/or their distributors as local laws and regulation permits. Please consult your own financial professional or Franklin Templeton institutional contact for further information on availability of products and services in your jurisdiction. Issued in the U.S. by Franklin Templeton, 1 Franklin Parkway, San Mateo, California, 94403-1906. 800-DIAL-BEN, 342-5236. FranklinTempleton.com. Investments are not FDIC insured, may lose value, and are not bank guaranteed. Issued by Franklin Templeton outside of the U.S. Please visit www.franklinresources.com to be directed to your local Franklin Templeton website. Copyright 2025, Franklin Templeton, all rights reserved. Podcast theme music by Adam Vidovsky.